All right, want to record a quick video just unpacking a conversation we're having with a lot of our clients right now. The largest asset managers under God's green earth are all in unison crying that the stock market is not going to achieve the rates of return the next 10 years that we've grown accustomed to the previous 10 or 20 years. So let's unpack some of these forward looking projections that some of the biggest asset managers on the face of the earth are issuing. Here's Vanguard. We love Vanguard. We think Vanguard's one of the good guys. Every single month, they release their market perspectives piece. This one was released here at the beginning of December of 2024. And they are doing a thorough analysis, not only of just capital markets here in the United States, but economies abroad, GDP here in the U.S., and they're looking at unemployment rates, inflation numbers, labor numbers. They're looking at central bank policy, not just here in the United States again, in Europe, in China, and the emerging markets. They're looking at China's economy. And they take all of these figures, they take all of these leading and lagging indicators, and they issue a 10-year annualized rate of return projection. And what Vanguard's out here telling us is they only see U.S. equities growing 2.8 to 4.8% per year. That number is prototypically 7 to 10%. And when you look at Vanguard's business model is low-cost index funds for do-it-yourselfers, buy and hang on for dear life, buy the S&P 500 index fund and just, don't look at it ever again. That was John Bogle's utopian dream, and John Bogle belongs on the Mount Rushmore. No one, in my opinion, has done more for the Main Street investor than Vanguard. And here they are analyzing all of this data and coming out and saying equity stocks are only going to grow 2.8 to 4.8%. When you break it down more granularly, value stocks, these are dividend stocks, 4.2 to 6.2. That's a little bit more optimistic. Growth stocks, these are those magnificent seven names, right? So Amazon and Microsoft and Apple and Tesla and Nvidia and Google. They only see these names growing 0.4 to 1.6%. And it would be one thing if it was just Vanguard. Like if Vanguard was out there on its own little reservation and they had a completely contrarian belief, then all the other asset managers, you might kind of discredit that and go, okay, they're making a bold prediction. Here's Goldman Sachs. Well, to be fair, Goldman Sachs predicts the S&P 500 in 2025 to go up by 10%. So it could be like a short-term day trade type perspective that you have, but they think the S&P 500 in 2025 is going to go up 10%, but their long-term forecast of U.S. equities, we estimate the S&P 500 will deliver an annualized total return of 3% during the next 10 years. That, here again, is one of their most bearish forward-looking forecasts they've ever made. Goldman Sachs. Here's Charles Schwab. Charles Schwab is a little bit more optimistic, but historical average of the S&P 500, 10.5%. In the next 10 years, we see 6.1%. And all across the board, almost every single asset class, they see underperforming historical rates of return. JP Morgan has come out. Over the last decade, over the next decade, we see the S&P 500 only returning 5.7%, whereas historically, the S&P 500 has returned 10%. In fact, in the last decade, the S&P 500 has returned 13%, but historically, it's been 10%, but forward-lookingly, it's only 5.7%. Here's Fidelity. Now, Fidelity didn't give us a clean-cut 10-year forward-looking projection like what Vanguard and JP Morgan and Goldman Sachs and Schwab did, but here's Fidelity's words. However, after the rise in PE ratios in each of the past 2 calendar years, valuations are now looking stretched. They're already in the 90th percentile. That's why I think it may be a challenge for stocks to repeat the robust performance that was achieved in 2023 and 2024. It would take a market into a bubble if PE ratios were to expand for the third year in a row. So we have Vanguard, over the next 10 years, U.S. equities 2.8, 4.8%. Goldman Sachs, 3%. Schwab, 6%. JP Morgan, 5.7. Fidelity telling us if the market continues to go at the current pace, we're already in a bubble. It's going to be even a worse bubble. So what's an investor to do? I know a lot of investors out there, especially individuals that we share a worldview with, are kind of happy about a Trump administration. They're happy that we have a pro-business White House and House and Senate. We're going to lower corporate taxes. We're going to get rid of regulation. We're going to gut the government. We're going to get back to deal making. M&A is going to go crazy. Deal makers, and we might lower interest rates. So a lot of us are optimistic that, hey, this stock market's going to do really, really well. But when you peer outside of the United States and you look at what's going on in Europe and China and the emerging markets, and the other big phenomenon is when you look at who has all the money, the baby boomers and the pension funds. Well, the baby boom is the largest demographic pimple in the history of, still living at least, in American demographics. And all of these individuals are shifting their investment perspective from growth, accumulation, to distribution, income, deaccumulation. So do you think that this group of individuals need to buy more stocks? Do they need to buy more growth stocks? Or do they need to go and buy treasuries and bonds? Boring stuff. Because when you look at this, U.S. treasuries, 4.1 to 5.1%. Any sane-minded person, if you were taking Vanguard's projections verbatim, hey, the stock market's going to give you 2.8 to 4.8, and you're going to lose a lot of sleep and ride a crazy, tumultuous roller coaster. Or you can just buy a treasury and make 4 to 5% and sleep like a baby. More and more money is going to be shifting out of the market into safer, more secure investments. And that's another major phenomenon that's going to be happening that's also going to act as an anchor to equity. So what is an investor to do? Well, I'm of the thought you never want to bet you're going to be right all the time, right? Because had you taken Vanguard's advice at the beginning of the year, they had this bearish outlook at the beginning of 2024. And now that 2024 is coming to an end, you took their advice and you put it all in treasuries, you would have missed out on a 20% growth year because, of course, the market did phenomenal in 2024. So I'm of the thought you never want to try to time the market. You never want to bet you're right year in and year out. You just want to bet you're not wrong. So right about now is a wonderful time to take inventory of what you own, put together a balanced approach. Recognize that interest rates are probably going to go down. You might have an opportunity to lock in higher interest rates right this very minute before Jerome Powell continues to lower interest rates. Recognize just because we have the cheeks and seats in Washington that share your worldview, it doesn't mean they're going to be able to pull levers for the market to continue to go up and up and up. Capital markets are ultimately driven by price to earnings ratios, valuations, you're buying businesses. There comes a point when you look at the multiples, when you look at the valuations of businesses where you go, this doesn't make any sense to continue to buy this business. I'm overpaying for it. Recognize that markets are going to pop, they're going to drop, and put together a balanced, commonsensical portfolio. I like to think my little firm can help you. Also be mindful of taxes and estate planning. We do it all, y'all. We can do your tax prep. We could put together your estate planning documents with our legal division. So lean into our office. Thanks so much. I thought this was helpful. I think it's helpful, at least. I'm a nerd. But hopefully hearing from the largest asset managers on the face of the earth might put your forward-looking projections of the stock market into perspective as well.